The very reason for the lesser fall in quantum multi-asset fund as compared to the benchmark or peer group funds has been on account of its lesser allocation to equities. Equities were trading at really high valuation, in upwards of PE of 25 for a fairly long time, whereas average historical PE of equity markets has been around 18.5. This really said that equity markets were waiting for a correction, and COVID-19 was more than a reason for it to correct. The quantum multi-asset fund had already reduced its allocation to about 27%, and therefore the impact of equity market fall was not as brutal as we saw in the benchmark or in the peer group funds, which had a high allocation to equities. Also to the rescue were its allocation to non-correlated assets like debt and gold. In debt, the bulk of the debt allocation for the multi-asset fund lies in the quantum liquid fund. Quantum liquid fund is much protected by the events that we are seeing in the external world because it does not take risk. It buys only government securities and therefore was cushioned on account of the external events we are seeing today. Gold, which usually acts as an excellent portfolio diversifier, was much helpful during these times of stress. If you see, whenever equity markets have fallen, gold usually does well. And even this time, that was true. Gold prices rose significantly higher when we saw steep losses in equity markets. And therefore, a mix of what was in place, a lower allocation to equities, allocation to debt and gold, all all this helped in terms of the lesser decline that we have seen in the quantum multi-asset fund as compared to the benchmark and as compared to the peer group funds. For most of the peer group funds, the allocation to equities as a mandate is much larger. Many of them have a minimum 65% allocation to equities. And this means that even if the fund manager is not comfortable with the overvaluation in equity markets, they still have to maintain 65% allocation to equities. And this meant that whenever equity markets fell sharply, they also fell along with it. And therefore, they were not able to cushion the decline as much as the quantum multi-asset fund did. And therefore, it's better to have a mix of asset, which is balanced into different asset classes. And therefore, the impact of such steep declines that we see in equity markets is much lesser. And that's what multi-asset fund did. Balanced funds, as the name suggests, have to be balanced in their allocations. With a 65% allocation to equities as a minimum, makes them biased towards equities and therefore makes the balanced funds as unbalanced. So one should avoid, if you're truly looking for a balanced fund, one should avoid with such a high biased allocation towards equities as a balanced fund. The very reason we did not have such a high allocation to equities because it would firstly make it unbalanced, and secondly, if you see asset markets goes through cycles of optimism and pessimism. So whenever there is volatility in asset markets, a balanced fund should take advantage of that volatility, use valuation as a metric to position itself, and therefore try to get a return that commensurates for the risk. The quantum multi-asset fund, it has equal allocation in a range of 25 to 65 for equities and debt. And there is also a component for gold allocation, which varies from 10 to 20%, which is like a portfolio diversification tool. And therefore, its optimal weights in the portfolio are in that range. So a balanced fund is balanced across allocations, uses non-correlated assets, try to reduce risk, and at the same time will ensure that over cycles, it is able to generate optimal returns. So that is the reason why we didn't want unbalanced fund in the first place. And we wanted investors to have an experience which generates moderate returns, but at the same time reduces the risk. And that is why we don't have that high allocation. As we have seen a decline in equity valuations and equity markets, we have increased our allocation to equities. We were at 27% before the crisis of COVID-19 hit upon us. which saw a steep fall in equity markets. We have used this decline to increase our equity allocations, and we have increased it significantly now, and will use any further declines to add more to equities. When market recovers from this fall and normalcy returns, uh, as equity markets rise, we will be benefited by that because we have already increased our equity allocations. When equity markets keep on rising and reach a phase where valuations don't make sense, we will reduce our allocation to equities gradually. And this will ensure that the first rational move of this boom that will take place, we will be participants in that. And whenever there is froth emerges, we will reduce our allocation. So you could expect better returns as compared to historical returns that we have seen for the multi-asset fund whenever there is a recovery in equity markets. Post that, it will moderate in terms of returns. Therefore, we will always try to give investors optimal returns, but the main criteria would be to reduce risk. So whenever we cite any risk, we'll refrain from taking those calls because we want to protect your hard-earned money, and we'll ensure that the risk is under control. But as far as the returns are concerned, we will try to endeavor and generate moderate returns for you at all times.
Mutual fund investments are subject to market risks. Read all